Hello, everyone. Welcome to Making Sense of It All. My name is Emma Reese. I work at the Better Policy Project. It's a project designed to improve economic and financial literacy. You can find more information about our project here on our YouTube channel or on our website at www.thebetterpolicyproject.org. Today, I'm presenting Douglas Laxton, our director, and today's video is the third one of the series. And this video covers how the economy has responded to price shocks, term premium, and 10-year bond rate. If you are interested in learning, you are more than welcome to follow along. Let's get started.
So it's Wednesday, and today we're going to have the release of the April CPI. Markets have been going up and down. The smooth landing trade was taking hold, and now there's a little bit of volatility. Everybody cares, is it going to be 0.2, 0.3, 0.4? What is going to happen to sticky price inflation? These are going to be things that we analyze today. What we want to talk about now, we talked about the potential for the term premium to rise on 10-year bonds. Okay, now, why are we focusing on 10-year bonds? Because the average maturity structure of the U.S. debt is a little bit below 10 years. So it's a good measure to think through the implications that if the term premium were to rise to 1, which was about what it was during the Great Moderation. So this is the period from 1996 up until 2007. So just before the global financial crisis, there was this period, the Great Moderation, where we had pretty anchored long-term inflation expectations. We did not have the economy responding to oil price shocks. I mean, in other words, affecting medium-term and long-term inflation expectations. And that was a big shock between early 2000s and 2008. We had the price of oil rise from about $20 all the way up to $150. So that's a gigantic increase in the price of oil. And so you might say that our monetary frameworks, did have a bit of a test during that period of the Great Moderation. It's not like it was just lucky draws of shocks. Now, in addition to that, though, I should say that the forces of globalization were probably containing inflationary developments. In other words, they were acting as a proximate cause, putting a little downward pressure on inflation and so on. And so you can think of that, bear that in mind. So you had increase in oil prices, and you had these effectively disinflationary forces coming from globalization and so on. Okay, so but now, as was the case during the taper tantrum, going to have a nice presentation about this by Anahit and Rudik, because they're going through that taper tantrum episode in detail, and they're going to show us how the term premium adjusted. Okay, that the period of the taper tantrum was a combination of both an upward adjustment in the expected path of the policy rate plus a pretty a snapback in term premium, and that's a big risk for today because term premium are very, very low. But and this is the big important message here. If you look at financial markets, so if you look at what is priced in options markets, the end of the Atlanta Fed funds tracker is now 4%. So I mean 4% at the end of 2026. And so you take that estimate at the neutral rate and you add on a 1 percentage point term premium, and that takes you up to 5%. Well, you look at the table and you can see that the Congressional Budget Office's assumption for the 10-year bond rate is 4.1% between 2029 and 34 and so on, right? So it's almost a full percentage point below what would be 5%. Okay, and now, so under these assumptions, with this 4% long-term interest rate, the government debt to GDP ratio rises quite substantially, and that's simply because the fiscal policy is being run with a about a 2.5% deficit, primary deficit, and so on. And so we want to focus in on those numbers. And so the primary deficit down here, okay, this year is 2.5%. Put that number in your noggin, and you can see it's between 2 and 3% in 25 and 34, and so say a 2.5% primary deficit. Well, if the interest rate, 10-year bond rate, were to go to 5, that means that we would need to have that primary deficit swing to a surplus to stabilize the debt process. Okay. And if it didn't, and you had 5% interest rates, this debt process, which grows from 99 to 116, okay, in 2034, if interest rates were a full percentage point higher, based on this assumption of the primary deficit, the debt dynamics would be quite a bit more explosive. Okay, now that could be very problematic because as 80 Bender is going to talk about in a future seminar, who's an expert on fiscal crises in Israel, as well as the framework that they put together to recover from that fiscal crisis. He'll tell you that the perception of a fiscal crisis really depends on two things: the fundamentals, okay, in this case, extremely high levels of government debt, a primary deficit, and of course, based on the excellent surveillance of Sergei, that understands the U.S. political system perfectly, he is very skeptical that the Democrats and the Republicans are going to be able to get together and to find 4 or 5 percentage point swing in the primary balance. In other words, cutting expenditures, by several percentage points, or raising taxes by several percentage points. So what 80 would tell us is that at some point, if the market were to take a run at them and the 10-year bond rate were to go to 6, now the question is, what's stopping it to go to 7? Okay, because once it starts rising, once term premiums start rising, and once people start realizing that longer term interest rates are going to rise in the future, then of course people will be reluctant to hold government bonds because they will be experiencing capital losses on those bonds, and therefore they will demand higher term premium or compensation for that interest rate risk. And now you have a global financial crisis, or the perceptions of global financial crisis, or the perceptions of a fiscal crisis. Okay, and if you have the perceptions of a fiscal crisis, you will have a perception of a global financial crisis, because this will also be true for other countries like Italy and Japan, and there was other high debt countries. But more importantly, thanks to the wonderful wisdom of the people that put together the regulatory framework for financial stability, they assumed that government debt is risk-free. Well, in this story I'm telling you, not only is it not risk-free, it could be it could be the thing that the catalyst that basically sets everything in motion. Because of that assumption that government debt is risk-free, it means that when banks put it on their balance sheets, they don't have to hold as much capital against it. Okay, and so that's what I mean. Thanks to the wisdom of our regulatory framework for financial stability, it assumes in the risk weighting of assets that that government debt is a good thing on your balance sheet, that it's a liquid thing, and so and now of course we saw the vulnerabilities when we saw some banks that had put a lot of long-term bonds and mortgages on the asset side of their balance sheet. When interest rates rose, we saw, the vulnerabilities of say the what we hope are extreme situations. But it's quite likely, like totally likely, that if we start getting 10-year bond rates up to 6 or 7, it won't just be a small group of banks. It will be a lot of banks that will be exposed to that kind of risk. Okay, so why do we care about the CPI 0.1, 0.2, 0.3, 0.4? It should be inconsequential. And the answer is that it could trigger a perception that interest rates might have to be higher in the future. Once that process starts, it's sort of like jumping on a roller coaster where you're going downhill. That's how quickly the bond market vigilantes could engage here. Okay, so that's the story. Let's get ready for the CPI release and see how the narrative adjusts in markets.
Thank you for watching our video. For more information on the bootcamp, you can go on the Better Policy Project website and scroll down. You have the option download brochure, and there you will have all the significant dates, the designated speakers that are going to be giving the classes, and also like a small introduction to how the bootcamp is going to work. Then we can also take a look at the courses that we have available. These are courses that help any economist or beginning economist to learn how to use these programs, such as Python and Diner Julia, MATLAB, all these important programs. Thank you so much, and hope to see you in the next video.